Good morning, everyone. I'm Gary Black, founding partner of the Future Fund. With me today is David Kalis, my co-portfolio manager on the Future Fund. Thanks for joining us today. Today, we're going to talk about four things. One, we're going to talk about a visit we had with Tesla management last Wednesday. We actually took a plant tour, and then we spent some time afterward. Two, we're going to talk about Elon's continuing sales, and both discretionary sales, which he used in the beginning, and then more recently his 10b5-1 sales. I'm going to talk a little bit about how that all works because there's a lot of confusion out there. Three, I'm going to talk about the EV credit, the progress of the Build Back Better bill in the Senate, and some other catalysts. And then last, I'll talk about our fiscal year 22 forecast. We're looking for about $12 in earnings, which is way above the streets at 850 and change, let's call it, and our $1,400 price target in 6 to 12 months, which we are holding to. And I'm going to try to leave plenty of time for questions. And if you have a question, you can just type it in on the screen, and we'll try to respond to it. Let me just start with our thesis on Tesla, because I think it's helpful just to remember why we're invested in the stock. We believe as EV adoption continues to soar, you're going to see 2022 through 2025. Both Tesla volumes and estimates way exceed estimates, and that creates a huge opportunity. They're just way too low. We believe that Tesla is going to grow in line with EV adoption and then hold its roughly 21% EV share. But as it doubles capacity with Berlin and Austin opening imminently, and it continues to grow, we're looking for by 2025, 5.2 million deliveries. And we're looking for gross margins of about 29.5. I think we're going to be low on the gross margins, and I'm going to talk about our management discussions. But I came away thinking, if anywhere we're too low on that, we're also way too low on EV adoption. Obviously, it's not fun with Tesla down today about 6%. We're down to 960, but we do have a $1,400 price target. And unlike some others, we are keeping our Tesla position right at around 10%. So we're still looking for about 45% upside. So let me start by talking about the management visit. We went on a tour of Fremont. It's an incredible thing to do if folks haven't done it. It's just so high tech, so automated. Most of the process is fully automated at this point. And one of the things that I came away with, and I know Dave came away with, is as they add new factories, so as Austin comes online, as Berlin comes online, all the technology and all the efficiencies they built into Shanghai will be even better. They learned a lot in building Shanghai, and Shanghai, as you may remember, produced about 150,000 EVs its first year. We're thinking that both Berlin and Austin can do the same in 22, and I guess the one thing I would say that was important to me is management still believes that both Berlin and Austin will come online at the end of the year. And for those that they watch the drone videos that are out there, it looks like there's a huge flurry of activity at both plants to try to get both of them up and running by in the next 3 weeks. So the first point I would give you from our management visit is I think management feels still pretty confident that both factories, both Berlin and Austin, will open by the end of the year. Two, we talked a lot about future expansion. How do you get to 5 million units by 2025, which again is our forecast from, it'll be about 900 this year. And again, something that was, I guess, an aha to me, but it makes common sense, is that they will focus on expanding Shanghai, which we've heard about. They're going to take the capacity up to close to 1 million units a year. If you look at November production, they're at about 60 a week or 60 a month. So that's 720 a year. So to get to 1 million is not a big deal. And then they're going to focus on expanding Austin and Berlin once they open. And again, that's the quickest, easiest way to get capacity much, much higher. So I think that's the second point. And then they're going to look at other areas. I do believe that both the UK and India are on their radar screen for new factories. And then the third area I would just point out, or the third insight, is the 1.5 million production. The street right now, I just looked this morning, is about 1.28 million for next year, pretty low. And they will probably get close to 900 this year. So 1.5 is a big beat. And again, you want to own stocks that are going to beat estimates. If the estimate's at 128 and they come in at 1.5, they're going to get much closer to my $12 earnings number for the year than the 850 or so that the street is estimating. And again, the way I get to 1.5 million is 450 in Fremont, 750 in China. And again, they're already doing 60 a month in China, so that could be much higher. And then both Austin and Berlin, 150 each. Again, when you look back at Shanghai, when they opened, they did 147, I think, the first year. Other thoughts from the plant visit: how much is just how much more efficient Shanghai is than Fremont. And look, Fremont's doing everything it can to maximize output. But when they built Shanghai, they had a blank sheet of paper. And one of the things that one has to recognize is as Berlin and Austin get up and running, they will use that same insight that they got, same distribution efficiency, same supply chain efficiencies in building the plant. And I think that's why you'll see at least 150,000 units out of both Austin and Berlin. I'd say the biggest, we talked a little bit about the street and why is the street so low. The street started this year, just so you know, 2021 earnings at about 390, and now the street is up to 610. So that shows how much the street has come this year, and it's all because of volumes. And it's a couple things. And again, management, when we talk to them, is not going to give you an answer. But you sometimes can get some insights based on how they respond and how they don't respond. So these are our insights after talking with management. One, EV adoption is going through the roof. And there's a tweet we put out this morning. There's an outfit called EV-volumes. They supply volumes to all the OEMs. They're worth taking a look at. They're in Sweden. They help us out a lot on different analyses. But we looked at it by region this morning. And again, you can look at our Twitter feed and you'll see it. And when you see that in every region, EV adoption is going through the roof. They have a forecast for fourth quarter. The first 3 quarters are actuals, and it's just BEVs only. We exclude anything that's a hybrid. But what you see, and this is important, that for fourth quarter, their estimate for global EV adoption will be 11.6%. And that's a huge number because our forecast for all of next year, for 2022, is 10. And our forecast for all of this year was 6. And we brought that up all year. And it looks like this year, fiscal year 2021, will probably end in the 7.677 range. So I think that's a huge upside surprise. And again, as I mentioned before, I think the second huge surprise will be auto gross margins. Auto gross margins, as you remember from third quarter, was 28.8, excluding the EV credit. We're using 28 for all of 2022. I think it's probably already above 30%. And I was originally thinking that as Austin and Berlin opened, they'd have to take a little bit of dip to get those factories up to speed. But now I'm not so sure about that because it seems, when you hear about that they, for instance, when they wanted to add the tent for Model Y, they got it done in 18 days. There's so much efficiency and so much technology that they can take from what they learned in China and what they've learned in Fremont as they've expanded. And it goes on a blank sheet of paper for both Berlin and Austin. Okay, so that was our management visit. Let me turn to Elon's 10b5-1 sales. This is a difficult topic, as people could tell, because Elon really could not have picked a worse way to do this. And I say this not tongue in cheek. I do think if the Twitter poll talked about that he was going to spend 6 or 8 weeks selling instead of the normal, you do a secondary, you get it done in a couple of days, I think the outcome would have been different. But here we are. Stock is down 22% since the sales started. So in a month, Tesla has lost 22%. People say, well, everything's down. Well, that's not true. NASDAQ is down about 2% since the sales started. And I can't give you a reason. Nobody within Tesla will really tell me why. Elon's talked about maximizing taxes. That's not really what I'm seeing. I know that when you look at the Build Back Better bill, BBB, there's a surcharge that's supposed to go in place at 10 million of 5%. Another surcharge, this is on ordinary income, of 3% that goes in at 25 million. So one could say if Elon has a 53% tax rate today, he could have a 61% tax rate next year if this thing passes. We're going to talk about that in a minute. That's one reason I think Tesla is off so much. Another is just the fear of rising interest rates. the Fed has made it very clear that it's going to accelerate the tapering, which today it was announced in November at 15 billion a month. It'll probably go to 30 billion a month, which means by March the tapering will be over, and then you'll hear more talk about rising interest rates. I guess where I'm a little skeptical that this matters all that much is because the 10-year is even today down at 144. It's at another six basis points, 143, I think. So the spread between what the zero is and people look at the 210 spread, 2-year versus 10-year, is very, very narrow for a tightening cycle. So I think when you look around the rest of the world, you see both Bank of England, which is going to make, they're having their central bank decision on Thursday, and ECB also on Thursday. Both of them are holding back on tightening because of COVID. And we don't know how bad COVID is going to be. We have 60-65% vaccination here, but Omicron is kind of still in its infancy, and at least in the UK, they're very much worrying about it, and it's to the point where both the BOE, Bank of England, and ECB are going to hold back on tightening, even though people thought they would tighten at their December meeting as well. So what you see is not just Tesla down, even though Tesla's down by far more than most of the other growth stocks we own. But you see names like Snap down 4% today, Shopify's down 4%, Etsy's down 4%. So there are a lot of stocks that are down in the last 4 or 5 weeks. It's not just Tesla. Okay. Let me just explain a little bit about the way this 10b5-1 plans work. I know a lot about it because I used to be a CEO and I used to have my own 10b5-1 plans. But you put them in place during an open window. So the open windows at Tesla, they open a day after earnings, and then they close 2 weeks before the end of the quarter. So this open window, which is still open, will close roughly around December 15th. Could be December 16th, but in the next week or so it'll close. And if you want to put a 10b5-1 plan in place for selling next quarter, you'd have to put it in now. So Elon's current 10b5-1 plan, and you can string them along. You could basically have a 10b5-1 plan go for many, many quarters. But when you're selling this many shares, that's not usual. And so Elon's current 10b5-1 plan, which was put in place September 14th, which was 2 weeks before the end of the third quarter, spelled out in detail what dates and what quantities. And what many of us have been, I guess, not surprised by, but it's something to note. Every one of his 10b5-1 sales has been for the same amount, 934,091 shares. And those can continue. And so even if he had what we call MNPI, material non-public information, he could continue selling under his 10b5-1 plan. And what's been interesting to me and others is that he hasn't really sold any shares discretionarily since that first week. Everything has been under the 10b5-1 plan. So I think it's fair to assume, and again, I tried to ask these questions when we met with management, that Elon will continue selling through the end of the year because, again, you've got a 5% ordinary tax surcharge going on in place above 10 million, 3% above 25 million. And as most people know, when he exercises his options, which expire next August, he has to pay ordinary tax on the difference between where the price is at exercise and what the options were struck at, which is 624. So that's a huge tax bill, and it's 15 billion, give or take, if he exercised all 22.8 million options. But he would save a lot of money if he did it this year versus next year. That would not be the case if Tesla were to go through the roof next year, because again, when you factor in Tesla going up but paying higher taxes, he'd be much better off doing it next year. But that said, it seems like he wants to get most of it done this year. So that's how it works with the 10b5-1 plan. I expect the stock today is off 6%. It's hard to know on any given day. I've often criticized the process because if you're a hedge fund and you've got a trader who gets paid for to study these things, and they have a lot more market insight than, for instance, we do, they can tell when Elon's selling. They know who his broker is or who they think his broker is, and unless he's switching up brokers every day, they can get in front of his sales because they know he's going to sell. Once it looks like he's selling, they know he's going to have to sell 934,000 shares. They can see based on the postings how he's traded in the past, versus VWAP or over the time of the day. They could track it, and they could very much get in front of his selling. And that's been my biggest criticism of this process versus if you just do a secondary, you go out to a bunch of investment shops, you say, would you like to buy Tesla at a discount, 3 to 4%? You get it done in 3 or 4 days and it's over with. Okay. So I expect that's going to continue. And I do think that's one of the reasons why Tesla's down today. Just for numbers, you see what we post on Twitter. He's about 65% of the way through his 17 million shares sold, which means he's got about 6 million shares left. He's about 56% of his way through exercising his 22.8 million options, which means he's got about 10 million options left. Okay, let me turn to the EV credit and the Build Back Better plan. This is definitely a moving target. So I'd say as of this morning, I'm more on the camp that this is not going to happen by the end of the year. You have to watch, what Senator Manchin says from West Virginia. He's a moderate Democrat. He's the swing vote. And so all 50 Republicans are going to vote against the Build Back Better plan. 49, maybe 48. The other holdout, if you want to call her that, is Kristen Sinema from Arizona. She seems to be kind of straggling the fence on this. But Manchin is not. Manchin's biggest concern has been all along inflation. He thinks adding $2 trillion of stimulus is going to make the inflation problem we have even worse. And that's why he's been holding back. He's also expressed his reluctance to back 3 things. One is the SALT, that's the state and local tax cap, which is getting raised from 10,000 to 80,000. He's also expressed, again, uncertainty about the 4 weeks paid leave that's in here. And he's expressed, more close to home, the $4,500 tax credit, EV tax credit, if you're a union shop. And so in order to get his vote, they got to at least satisfy these basic, we'll call it complaints that he has. And so here's the bottom line. The Dems will take a vote this week to see if they want to vote before Christmas. Schumer's saying it'll get done before Christmas. I know that Biden is meeting with Manchin this week, maybe today. If they can't get Manchin on board, then there's no point of voting. They should just push it back till next year, which again, I don't think is a big deal either way. I think on one hand, I'm a big believer that the EV credit is a big catalyst. It's not a catalyst today because, as many people have pointed out, Tesla sells all it can produce, but it will be down the road, especially as capacity gets doubled and as they continue to sell more and more different types of products here, especially more higher priced products, whether it be Cybertruck, whether it be Roadster, which probably wouldn't qualify because with Roadster, as you know, it'll be above it's a $55,000 limit on a sedan. That's an $80,000 limit on SUVs and pickups. But I think it'll help with Cybertruck. Okay. So that's about all I have to say about the EV credit. The other catalysts we could think about, I think Berlin and Austin opening, and again, go back to what management seemed to indicate to us before year end. I think those will be positives because it'll force the street, which has been very slow to take estimates up, to not use a number as low as 1.284 million, which is where they are this morning for volumes for next year. And again, I get 1.5. Some people have responded to me, it's going to be even higher than that because Shanghai is going to be higher than 750 next year. But again, 450 Fremont, 750 Shanghai, 150 each Austin and Berlin. And again, for now, Tesla is still capacity constrained, meaning they could sell every single unit that they produce. So that becomes the delivery estimate. Okay. So that's one catalyst, Berlin and Austin. Another catalyst I think is worth thinking about is S&P, I do believe, will raise Tesla to a investment grade credit after the fourth quarter earnings. So after, let's call it January 25th, they're one step below investment grade today. Tesla bonds trade as if they're already investment grade. But I think once it formally happens, you'll have a lot of mutual funds that can't hold Tesla today. And it's not a huge number. I can't put a number on it. But there are some that you have to have at least an investment grade credit or they can't own it. And then one other thing I just want to make a point about Tesla, a lot of people think of it as a high PE stock. It's not. And so if you go out to next year and you use my numbers, it's trading about 80 times versus 55% growth. If you go to 2023, it's going to earn about $19 a share, which means it's trading at about 50 times earnings. So when people think about high PE stocks, they think about, 100 times earnings. They don't think about 50 multiple. If you got to 2025, we're down to 24 times earnings if my numbers are correct. So it's just something else worth thinking about. Okay, let's talk about my forecast and then the $1,400 price target. We have a forecast of $12 in earnings. We're thinking volumes will be about 1.5 million. I told you that we have a pretty low, in my opinion, gross margin percentage assumption. It's about 28. We have EV share, Tesla's EV share. As you know, we do EV adoption times EV share times SAR, which is the selling rate globally, and that equals volumes. We have the Tesla's EV share at about 21%, going from now until about 2025. And so just look at the tweet that I put out today from EV volumes. For fourth quarter, their estimate is 11.6 on EV adoption. And again, as the TAM expands, as Tesla brings out Cybertruck, as Tesla brings Model Y to Europe, which it hasn't been there. And remember, when you're making EVs in Europe, you're saving money on the import tax, you're saving on shipping, so they can either reduce costs or they're going to make more money on it. I think they'll probably reduce price, I'm sorry. So once we get to next year, we could see EV adoption up in the 11-12% if it finishes the year at 11.6 for fourth quarter, as EV volumes is forecasting. So take a look at that. So that's my assumptions. We come up with, again, about $12 in earnings when you put everything in. We don't have much revenue or profits for either solar or service. A lot of people give me grief about that, but it's just very small. And while I do think by 2025, so as you think about our price target, we have about $8 billion of revenue each for both solar and services. It just doesn't really move the needle in the next couple of years. Okay, so let's go to the $1,400 price target. How do we get that? We have $40 in earnings for 2025. We have 5.2 million in volumes. Again, I think the capacity expansion will be from making Berlin bigger, making Austin bigger. Obviously, Shanghai is already getting bigger. I think the UK and India will be probably the next places where they add factories. They have to get India to reduce the import tax going in so they can prove that they can actually sell Teslas in India. But I get to $40 in earnings. And again, you can see my little summary sheet. I put a 50 PE on in 2025. And again, you can't just blindly put 100 PE on Tesla in 2025 because it's slowing. The growth is slowing. It will slow because EV adoption, when it goes from 3 to 6 and then 6 to 12, that's 100% growth if you think about it that way. So once you get to about 30% EV adoption, which is what I have in 2025, we have it growing, but it's not going to grow at the same percentage it was before. So we have earnings growth slowing down to about 20% post 25. It's more of a mature company. It'll trade like Microsoft and Apple in theory. You put a 2.5 times PEG, which is where Apple, Microsoft traded it. That's 50 times. 50 times 40 is 2,000. We use a 11.6% discount rate on Tesla. We get that by we use a 2% 10-year treasury. So we have some room on our 10-year treasury rate. It's if you look back over the last 50 years, the premium, they call this the equity risk premium, equities versus bonds is about 6%. Okay. And then Tesla has a 1.6 beta. You have to risk adjust it. So you take 1.6 times 6, that's 9.6, add 2%. That's 11.6% as a discount rate. Okay. And I put out some things over the weekend that, every 1 percentage point increase in the 10-year treasury yield takes about 4.5% off the stock market. You multiply that times the beta of 1.6, that'll be what Tesla would be down by if interest rates start rising. Biggest opportunities and risk. I think the biggest opportunities are EV adoption will be much faster than what we are projecting. And I think gross margins are going to be much, much faster than we ever produced, particularly after our factory visit. I think the biggest risk is EV share of 21%. As much as I want to dismiss Tesla because they've been wrong, Tesla Q, because they've been wrong for so long, I do think as the strategy has changed, as the legacy ICE manufacturers put more and more money into EVs. I don't know if anybody watched football yesterday, but every single car commercial was EVs. And I'm not saying Tesla should be spending money on advertising. But the point is, it's getting much more competitive than it's been the last 3 or 4 years. What you didn't see on NFL Sunday EV commercials. And you have very aggressive spending, you have very aggressive PR efforts, and it's a different strategy today. Before you had the OEMs creating whole new brands like Audi e-tron. Now they're using their existing number one brands, Porsche Macan, Ford F-150, and they're just bringing in an EV line. So it's a much better strategy because you don't have to build any brand equity. They already know the brand. So I would just say that that's the biggest risk. And I'd say the other big risk is just single man risk. Elon, unlike the folks at Apple, folks at Microsoft, folks at Google, folks at maybe Facebook is similar. He has no strong number two. And the biggest worry I have about Elon, and I love the guy. He's Time Magazine's Man of the Year for a reason. He's changed the world. Is he wants to poke the bear, and when you poke the bear's going to bite back. And I do worry about that. That at some point, that is a risk we have to worry about. That whether it be the SEC or somebody else will come after him if he continues to poke the bear. So I would just hope he would stop doing that. So let's just summarize. 40% upside, 6 to 12 months. The reason I use 6 to 12 months, and this is just a Wall Street kind of convention, because we know that markets are inefficient in the short term. That's how we try to make money. We think we know things that the market doesn't know. My assumption is that within 6 to 12 months, the market could figure out what we know about EV adoption and about gross margins being faster, and then street estimates will catch up. And that's why we use 6 to 12 months in our $1,400 price target. Last thing is just about the Future Fund. We had a rough November. We were about 300 basis points above our benchmark, which is Russell All Cap Growth, on November 8th. And we've dropped, a fair amount, 600-700 since then. 200 of it's been due to Tesla. But we're sticking with Tesla. And we believe, we have high conviction that once Elon stops selling, once the 2 plants open up, once they go investment grade, and once people see the numbers for fourth quarter, the stock will again start following fundamentals. And so our conviction remains high, and we believe that Tesla will rebound. If you believe, and you can read about our investment philosophy and our investment process on the web, we're very long-term investors. We're very concentrated investors. We've, for instance, our top 5 position are Tesla, Google, Tencent, which is the largest internet company in China, Airbnb, and Hog. We've gotten a lot of grief about Hog, but as you can see this morning, it was a very good bet because now they're going to separate via SPAC their electric bike business, and it's the stock's up 10 or 11%. So sometimes it doesn't always make sense. DM me. I'll try to explain why we own different stocks. And we think we're worth investing in. And again, because of Tesla and some other growth names that haven't done well in November, our stock, which is FFND, is lower than probably it should be. Okay. So with that, let's open it up for questions. And Dave Kalis, my co-portfolio manager on the Future Fund, is going to join us and I think kick us off with a question or two.
Okay. Good morning, everyone. So we have a couple of questions, and these are questions that come up from time to time. Mostly about the long-term growth of Tesla. So we've had more competition in the market and more public competition in the market with Rivian, Ford F-150, and then the Cybertruck delay. So that concerns people that maybe Tesla is behind the curve there. So Gary, could you just talk a little about what you think about the competition, especially in the pickup market? It's a very large market. I believe there's 45 million pickups that need to be replaced over the next 10 years. And then how does Cybertruck fit into this? It's been delayed. And your thoughts. I know you ordered one. Just give us your thoughts on sort of that market and the competition in general.
Look, the competition is definitely worth watching. I actually think so. Rivian has been out, for a month public, and I think it's already had an effect. We've already heard that, for instance, Cybertruck, when it comes out, is going to offer, a 4-engine option instead of a tri-motor option, which I don't know if it's a direct result of Rivian doing that, but I think having really good, strong competitors is going to force Tesla to even be more efficient and prioritize better. So I did a poll probably a month ago on Twitter. What's the highest priority for Tesla right now? And Cybertruck was number 1 by about double number 2, which I think, if I remember correctly, was either plan expansion or FSD. And I do see a step up. And when we met with management, it's clear Cybertruck is their number one priority. You've seen a lot of Cybertruck, stuff out, but I feel like this is something that management is focused on getting out before the end of 2022. And I think it's going to be huge. I mean, the last number I saw was about 1.3 million pre-orders. Now, obviously, you can't just throw that onto your volume forecast and assume it's going to happen. But if Austin can make 250,000 a year, you definitely could build that. And the ASP is going to be much higher on the Cybertruck. I tried to get them to tell us what the ASP is going to be, because when you reserve it, you don't really know what the ASP is. They'll start with the quad motor, the performance Cybertruck first, and then they'll work their way down, which is the way everybody does it. But you could wind up with an ASP that begins at 49.9 on Cybertruck and quickly gets up to 89.9 on the quad motor version. So that'll help ASP. I've gotten into a lot of disagreements with people on Twitter about what the ASP is going to be in 2025. This is probably where folks disagree with me most, other than EV share, is I have an ASP that's 48.8, I think, if I remember correctly. And most of Tesla is using numbers like 40. And they're forgetting that Model Y is going to Europe, which is higher priced. And then Cybertruck is also going to be, and both of those will be covered by the EV credit. Okay, even if Roadster's not going to be covered. In terms of like who is doing a great job, I think Rivian's doing a great job. I wouldn't buy the stock here because it's way, way, way more expensive. But quite frankly, when I go out to 23, it on an enterprise value to revenues, because obviously they have no profits, they haven't had any deliveries yet, and we joke about that, but they will. On enterprise value to revenues, they're about the same as Tesla. But Tesla's probably cheaper today because it just keeps falling. But I do think they have a credible product. Obviously, Motor Trend citing as 2021 Truck of the Year is going to help. I do think they have a great management team. I think their advertising is pretty good. I do think they'll be number 2 in profits within a few years. Number 2 in volumes will probably be VW, just because they have 30 or so EVs out there right now. And Porsche's doing pretty well with Taycan. But even Taycan, when you dissect the numbers, a lot of it is just cannibalizing Panamera. So back to competition in general, I still think it's largely kabuki theater. Ford and GM are pretending. They're saying, well, we're going to invest all this, we're going to invest all that. But their numbers aren't great, and their volume numbers aren't great. I think it's going to be very similar to what happened with cell phones when iPhone came out and basically disrupted the basic cell phone industry. And Nokia, RIM, and Motorola could never, ever catch up. And I think with Ford and GM and a little bit of Volkswagen, they're hardwired to think in terms of ICE engines, and their distribution is set up so different. So I think it's going to be hard for them to catch up. So I think the new players are actually going to do much better than people think. And the old players, GM and Ford, are going to do much worse than people think.
Okay. The other big debate around Tesla is obviously FSD. And, the question is, does it work? When is it going to work? There's been a lot of new versions come out. So what do you think there? I mean, from an investment standpoint, and then also from a practicality standpoint? I know you don't put a lot in your numbers at this point, but what do you think about FSD? Just give us a little feedback there.
If you had to pick a question that nobody wants me to answer, it's this one. Look, people know my views about FSD, and it's not that I'm not a fan of it. I'm an FSD beta tester. I don't talk much about it. I think FSD is a great add-on product, I guess, and I'm not an engineer. Okay, but I've seen a lot of competitive products come out. I've seen a lot of things happen when people try to add options, and then competitors have to respond. And I guess where I am on this is, I think FSD is going to continue to decline in take rate. Right now, it's about 12% globally, and so the way I look at it is, and I do put it into my numbers. There's a misnomer that I don't do that. I take the EV volumes, I multiply it times the take rate. I multiply it times $10,000, and I use about half of that. And then the other half I do at $199 a month. And that goes into my revenue numbers. So it's in there. I guess where I disagree with a lot of the Super Bowls is, I think a lot of people are going to get to full autonomy, being level 4 autonomy, level 5 autonomy, right around the same time. And even if Tesla gets there quicker, I still think, again, this goes back to poking the bear. I still think you're going to have the regulators may approve a whole bunch of them at the same time. So I'm not sure that you'll ever get a robo-taxi advantage. And I guess that's where people are adding some value. So I have it in the base value, the base EV business on revenue. But to really add $1,000 or $500 to the price target, I can't get there unless I make some really heroic assumptions about how much for ride hailing, and we'll just call it robotaxi for lack of a better word, unless I make some really heroic assumptions about market share that Tesla's going to get. And because I don't believe that Tesla's going to have an advantage that's that much bigger than everybody else by 2024, 2025, I don't want to add any value. So I think when you look at my $1,400 price tag, I'm being conservative because I'm not adding it. But I do believe that FSD is a great product. It's improved dramatically from when the FSD beta version first came out. I think sometime in 2022 it'll get approved for use. The beta version will be approved for use everywhere. And so I'm a believer in it, but I'm going to stick with adding it to my EV revenue as an add-on rather than building a whole new business around it.
Okay. And then one final question is really around the street expectations, the sell side expectations for Tesla. Obviously, a very large market cap, big weighting in the benchmarks, but it seems like the street is always behind. And the Twitter community and you have been way ahead of the game on volumes and earnings. I mean, you've been a former sell side analyst. I mean, why do you think that is? And do you think you're going to get over in 2022 maybe more conversion of the sell side street and more institutional backing of Tesla?
The problem with the street, let's start with the street, and then let's just talk about, so the street is the sell side portfolio managers at Fidelity, Alliance, Jennison. That's what we call the buy side. The street being the sell side, they're auto analysts, and they compare Tesla to GM, Ford valuation. And whether we like it or not, and it's not proper financial analysis, they look a lot at PEs. And they tend to look at, like right now, they're going to flip the calendar and start for their clients. They're going to start posting fiscal 22 and fiscal 23 Ps. Nobody's going to care about 21 anymore. And on fiscal 22, street earnings, Tesla still looks expensive on a PE basis. And that's not the right way to think about it. If anybody's ever taken a basic finance course, it's discounted cash flow. You can look out either at the cash flows over the next 5 or 10 years, put a terminal value on. And if it's cash flows you're using, you discount it the cost of capital. If it's earnings you're using, which is what we use, you discount the cost of equity, which to me is a higher bar. And I think the street just doesn't look long term. I think they're looking at the next couple of years saying, when you look at Ford and GM trading at less than 10 times earnings, Tesla up there at 100 times earnings just looks a little bit crazy. I think the bigger question is, why don't they get the volume numbers right? And I tried to have this conversation with Tesla management when I met with them. And I just think they believe, and I think they're wrong, that is most of and again, they're auto analysts, so they're very close to GM, they're very close to Ford, they're very close to Volkswagen. They believe that as all these guys invest money in EVs, they will take some EV share away from Tesla. And I know a lot of people disagree with the structure we use, where we take SAR times EV adoption times EV share, but it is the language that everybody talks about. And if you're on the buy side, that's the language people talk about. If you're on the sell side, that's the language. So you could talk about Tesla overall volume, and that could be a worthwhile goal, but it's not a high enough bar for Tesla to grow its share. And so when you talk about the stock price will grow if Tesla can hold its EV share, and I believe it will. And the reason I believe that is because they're expanding TAM. Okay, so TAM is expanding because of Cybertruck. TAM is expanding because they're building a plant in Europe, so they won't have to ship it anymore from China. And TAM is expanding because of we'll call it the Tesla Compact, Tesla Q. People call it Model 2. People call it Model A. Let's just call it Compact, and that's going to expand TAM. And I think that's why they'll be able to hold their 21% share. So I think the street, because they're short-term oriented, because they're auto analysts, they don't like Tesla. But I can't understand why they don't get the volumes right. And the only thing I could conclude, having been a sell-side analyst, it's more of a marketing job, I hate to say this, than an analytical job. And if you have a sell or a hold on Tesla because you don't like the valuation at, let's call it 110 times earnings, you have to have a model that supports that. And so you almost work backwards. You say, okay, I don't like the valuation, so therefore I'm going to keep my volume estimates low so that it'll justify the math. Because if you put in 1.5 million units for next year, you're going to have earnings above $10, and then you're not going to be able to have a sell on the stock. So I think that's part of it. And look, I'm cynical because I was a street analyst for many years, but that's the way it works. It's a marketing job, not an analytical job.
Okay.
You agree
that's
with
it.
that?
Yeah. No, I do. I do. That's it for the questions. So you want to wrap it up for us?
Okay. So thanks for joining us today. Again, we believe very strongly in Tesla. We now have 45% upside from where the stock is trading because Elon is selling in the way he's selling, as opposed to doing a secondary up to 1,400. I think that's 6 to 12 months. If we were to hear that he's going to stop selling, and he could, one thing I forgot to mention, he can terminate his 10b5-1 plan. You're allowed to do that. You just can't change it. That would be positive for the stock, because then people assume he's just going to do the rest of it in the secondary. So I think, look, we've got to get the selling to stop for the overhang to disappear. The 2 plants will open up. The EV credit's a catalyst. The investment grade credit after fourth quarter earnings is a catalyst. And I think we're going to get to $1,400 within 6 to 12 months. So it remains our largest position. Okay. Thanks everybody for joining us. Bye-bye.